Good morning and welcome to another edition of From the Desk of Dan Moy. And we usually start these reports with a market update. And there's a lot to talk about. The last month has been very unusual. We hopefully are ending what has been the longest government shutdown in history. And it's kind of interesting when you talk about the markets and the economy, as Jerome Powell famously said recently, about rate cuts in December. He says, well, we don't have any economic data. So what happens when you're driving in the fog? You slow down, right? So are they going to continue rate cuts? Well, they don't have any data. So December, the odds are maybe they might pause for a month. You just never know. But 2025 has turned into a pretty amazing year financially and economically by almost every tracked measure. The Atlanta Fed's GDP model is projecting 4% GDP growth for the third quarter of 2025. That's well above the long-term historical average of 3.2%. And meanwhile, the S&P 500 has climbed roughly 15% year to date. Gold, despite a recent pullback, is still up 53% year to date. And the home price index continues its post-pandemic climb. And even the federal government has scored a modest win with the enormous federal deficit declining by $41 billion compared to 2024, thanks in part to tariff revenues. Now, the bad news on that side, of course, the Supreme Court could unwind that as it considers the legality of the Trump administration's application of tariffs. So, if that happens and the government owes $800 billion back to businesses, that could be kind of a mess too. But by all measures, Americans are doing exceptionally well if you have assets. For those without assets to appreciate, the picture looks a little different. If you're early in your career or living paycheck to paycheck, there's just as many statistics to show that all is not well. Chipotle, which once seemed bulletproof, reported third quarter earnings that fell short of expectations. And the CEO said the core demographic of 25 to 35-year-olds is eating out less. This group is facing several headwinds, including unemployment, increased student loan repayment, and slower wage growth. He says, we're not losing them to the competition. We're losing them to grocery and food at home. And there's quite a few other employers that have said the same thing. The story gets bleaker when you look at car repossessions. According to Cox Automotive, lenders seized approximately 1.73 million vehicles in 2024, up 16% from the prior year. Current projections indicate as many as 3 million vehicles could be repossessed by the end of 2025. That puts repo rates at levels not seen since the Great Recession in 2009. So how is this all true at once? Apollo Global Management calls it a K-shaped economy, with the two arms of that K moving in radically different directions. If you own stocks, gold, or real estate, 2025 has been incredible. Your portfolio is up significantly. You're earning 4 to 5% on your cash. Your home is likely appreciated. The dividends keep rolling in. The economy looks great. But for those who rely on their paycheck to get through the month and don't have savings and turn to credit cards for the unexpected, the economic outlook is increasingly desperate. Higher interest rates that benefit savers are hurting borrowers. For new car loans, the average interest rate is near 7%. The average monthly payment is $750. And to add to that, below average new car prices top $50,000 for the first time ever last month. For someone earning $65,000 a year, that's an impossible math equation. Meanwhile, student loan payments have resumed after years of pandemic forbearance. Outstanding credit card balances are up 5.75 year over year, rising by $24 billion in the third quarter. So, it depends on where you sit in the economy right now. If you have assets, you're looking good. But for a lot of the people out there, life doesn't look all that great. So that's where we're at. The Fed meets next month. It's hard to say what they're going to do. I think they might pause it for a month because, again, we haven't had any economic data. Hopefully the government reopens. It's always, we don't predict, we prepare, so you have to be prepared for whatever happens next. You want to have a safe bucket. You want to have a growth bucket. This thing could go higher for a lot longer. AI is kind of a double-edged sword. It's driving the market higher, the tech companies that are driving the market higher. But at the same point, they're getting rid of jobs. AI is getting rid of jobs, and Amazon's laying off, and a lot of these companies are laying off. So careful what you wish for. Yeah, they're driving the market higher, but they're also decreasing or increasing unemployment as we speak. So that's kind of the update for the market. We have our mailbag. We always get questions, and one of the questions we always get is, how much can I safely withdraw? What's the right percentage to take out each year without running out? Is the 4% rule still valid? The 4% rule was a rule by Bill Bengen back in the late 90s that basically said, 60% stocks, 40% bonds. You start at 65, and if you took out 4% a year and increased it by inflation, every year there's a 95% chance you'll make it 30 years. In the late 2010 era, that got lowered to under 3% because we had two crashes in 2002 and 2008 and 9. It's probably higher now with the recent stock market volatility. I think our philosophy is a little different. Our philosophy is, let's set up, guaranteed income for the necessities of life and maybe even some of the fun things. And then you can have money in the market. Our big concern is taking money out of the market at the wrong time. The market's great. It's your inflation hedge, but you don't want to be selling when the market is going down. So if you have the income in place, and you set your portfolio up that way, I think you're on much safer, stabler ground than if you're just trying to do everything from a portfolio in the market. So that's kind of our take on that. A couple things. I've been traveling a little bit the past couple weeks. Last week I was in Texas for the Ed Slott semi-annual meeting. Probably had 450 advisors from around the country that gather twice a year. We were down in Austin, and we had spent 2 days with Ed. It's always a great opportunity to figure out what's the latest things in the tax laws. They still to this day pounding Roth conversions, take advantage of the low rates while we have them. So that was always good, reconnecting with some friends down there in Austin at the Ed Slott meeting. My wife and I, about a month ago, got a trip up to New England. We checked that off our bucket list. My wife has always wanted to go up into New England to see the foliage this time of year. So we flew into Portland, Maine, a really neat little town, spent a night there, and then we took a very scenic highway drive down through New Hampshire. And we stayed at a hotel called Bretton Woods in New Hampshire. And, I did a little research on that, and it's a very historic hotel. In fact, if you're a history buff, Franklin Roosevelt, after World War II, met with the European leaders at the hotel we stayed at, Bretton Woods, and that's where they signed the agreement to make the dollar the universal currency, the world currency. So, I was pretty impressed by that I stayed at that hotel, in Bretton Woods, and that's where some history was made. And the last thing I want to mention is, we had a client recently, that moved his money out of Vanguard over to another money manager. And when I questioned him about it, he said, well, I didn't know you guys did that stuff, So, if you've got a question about any of your accounts, we have really expanded our services. We do wealth management. We do the Medicare supplements. We're going to bring on a tax guy. So if you've got questions about anything, please pick up the phone and check with us. We're happy. And if we don't do it, we'll steer you in the right direction. Our upcoming events, I want to thank everybody who joined us for our 6th annual Pie Drive-By. We had one down at our office in Lewis. We had one in Middletown, and we had one here in Glen Mills, our big one in Glen Mills. So we really appreciate the generosity everybody shared, bringing in the food goods and the toys for tots. Our office is always loaded with this stuff, and you should pat yourself on the back and feel good. We're making other people's lives better by some of the donations that you guys brought to us. And keep your eyes out. We're going to have more fun events upcoming for 2026. Keep a lookout in your emails for updates regarding our upcoming events. As usual, we always appreciate Google reviews. So if you have a Gmail account and you've had a good experience with us, which if you have had a bad experience with us, please let me know so we can correct the situation. But if you've had a good experience with us, we'd appreciate it if you went on your Google account and gave us a review. It really helps us in the search engines. And finally, I want to wish everybody a happy Thanksgiving. I say this every year, but I think Thanksgiving is the most overlooked holiday out there. Seems like we go from Halloween to Christmas, and everybody just forgets about Thanksgiving, and it's one of my favorite holidays of the year. It's a time to just give thanks for everything that we've been blessed with. I usually put something up on our sign on 202 that says, gratitude makes what we have enough. If you're just happy with what you have, you ought to be gracious and have a lot of gratitude. And my favorite part of Thanksgiving, I'll just share this with everybody, is the day after. There's usually some pie left over, and there's nothing like having pumpkin pie on Friday morning for breakfast, a little bit of whipped cream on it. It's my favorite part of the holiday. Don't get me wrong, I eat a lot the day before, but it's always nice having that pie Friday morning. So I hope everybody has a great Thanksgiving as we head into the holiday season, and we'll talk to you next month. Have a great day.